Hi, everybody. Welcome back to Ox Talks. Thanks for tuning in to the show today. I appreciate the support for the channel. Please like the videos, hit that thumbs up button for me. Share the videos with people as far and wide as you can. If you haven't subscribed, please hit that subscribe button. It does mean a lot to me. We're getting a better response each and every day to the channel, growing the community. So thank you again. Let me jump into a topic that I've been seeing developing over the last couple of days. With regard to gold, but I have three interrelated articles I want to share with you today. So stick with me. Please watch till the end because this is very, very important stuff. You know, we have a transition underway with the global financial system. And yes, we're seeing gold prices rise. We're seeing silver prices rise. But there's a reason behind this. And I want to share all three articles with you and appreciate you leaving comments. Give me your input. Let me know what you think on this because this affects all of us. All right, so jump right in. First article is from today, Zero Hedge. This is kind of the lead in. Interest payments top defense spending for the first time in history. It says on Friday, the Treasury Department released a report. The monthly Treasury report shows spending and revenues for the full year, fiscal year 2024, which ended in September. It says the federal deficit topped $1.8 trillion in 2024. That's the third highest in history and eclipsed only by the two COVID panic spending years. It says that's not for lack of revenues, which were up nearly $500 billion this year, right? So revenues means tax revenues, right? It says, but the real shocker is the explosive growth in interest payments on the national debt. These payments hit $882 billion in fiscal year 2024, according to the Treasury report. That is a 35%, listen to this, 35% jump from last year at $8 billion with a B, more than we spent on the national defense. So again, you know, comment below, what would happen if we all had a 35% jump in our budget, right? In our outlay, interest on debt, anything like that. Imagine that, 35%. Says this marks the first time in our nation's history that interest on the debt has exceeded defense spending. And the gap is on track, it says, to greatly or rapidly widen, with the government spending $200 billion more in interest than in protecting America from our enemies by 2029. It says more debt and higher interest rates mean a sharp increase in the cost of financing that debt. And look, we know that the Fed is supposedly on a rate cutting cycle now. We'll have to see how fast that those rate cuts actually, if they do get rolled out. But look, that's also at play here. I mean, there's no doubt that there's going to be pressure on rates to keep those rates low so the United States can continue to service this ever-increasing debt burden, okay? So what does that do? I mean, it's almost like a race to the bottom, okay? And this will feed me into my next article really nicely here, unexpectedly, but I think it's a good dovetail in. But look at, as you lower the rates, the opportunity cost of holding gold becomes less and less, right? Because gold doesn't have a yield per se. And so, you know, as you start to have interest rates come now towards those lower zero-bound rates, you know, what is to say that gold will not start to take over as the ultimate safe haven asset? So let me jump into the next article I saw from Fortune, and I saw it yesterday evening, and it says, is gold safer than US Treasury bonds as federal debt keeps soaring? It says, backed by the full faith and credit of the federal government, US Treasury bonds have long been viewed as the gold standard in safe investments. In times of uncertainty, economic downturns, or full-blown crises, investors have flocked to treasuries as a haven. But what if actual gold is the new gold standard for a safe investment? Analysts at Bank of America asked that question in a note on Wednesday, explaining that the outlook for the U.S. debt is bullish for the precious metal. With debt as a share of GDP set to break record high in the coming years, the Treasury Department has to sell more and more bonds to investors who may demand higher yields on those bonds. And when yields rise, the price of bonds on the secondary market falls. So you're going to have this tug of war between, and people say, look, we just won't buy a U.S. debt. We won't buy the Treasury bonds if you continue to drop the rates and we don't get the yields that we want. It says, while lower rates are still bullish for gold, which doesn't pay, like I said, interest or dividends, higher rates don't necessarily put pressure on bullion anymore. B of A said, maintaining a gold price target of $3,000 per ounce. And if you guys watch the 10-year, when the 10-year yield used to rise, gold used to just get smacked down. And I agree with what this article is saying, is you're not seeing that correlate as cleanly or clearly anymore. A lot of times when the 10-year yield is much higher as it was today, yes, gold fell a little bit, but it didn't fall drastically. Okay, in a lot of days you'll see gold up in tandem with the 10-year bond. Indeed, with lingering concerns over U.S. funding needs and their impact on the U.S. Treasury market, the yellow metal may become the ultimate perceived safe haven asset, analysts wrote. Okay, again, we have funding needs. We just shared the last article with you that the interest on the debt is greater than it's ever been and expected to keep growing, even more so as an allocated element than defense spending for this country. Indeed, rising funding needs, debt servicing costs, and concerns over the sustainability of fiscal policy may well mean that gold prices could increase if rates move up, B of A said. And I would say, not an expert here, not a financial advisor, it's not trading advice, but I think if rates keep coming down, gold's going to move even faster. But what they're saying is it's not a foregone conclusion anymore that if rates do go up, that gold is going to necessarily go down. So again, it's all coming back to gold possibly being the answer or the real alternative to even U.S. Treasuries, which would be insane, right? Imagine how much money is in the bond market. It eclipses the stock market. So what happens if even a fraction of that started to move into gold? It says, with the supply of U.S. debt poised to continue surging, concerns have grown about demand and whether investors will keep absorbing more Treasury bonds. That provides a strong incentive to central banks around the world to keep diversifying their reserves away from U.S. debt and toward gold, B of A added. And we're seeing that. We're seeing that with central banks stockpiling massive amounts of gold. We're seeing that with the BRICS right now. I believe there's going to be a BRICS meeting in Russia this week. I read some stuff on that this morning. And they actually have a workaround now. The last article I'll share with you from Mohammed El-Arian, it discusses this, but they're actually laying the groundwork, and they actually have, it's a crude workaround payment system to challenge SWIFT, but they're moving forward, okay? Meanwhile, they're stockpiling gold. And recently we hear now from Russia, they're also stockpiling silver. It says, is gold a safer investment than treasuries? ? Ultimately, something has to give. If markets become reluctant to absorb all the debt and volatility increases, gold may be the last perceived safe haven asset standing, according to B of A. And the last article I will share with you, a friend of mine sent to me about an hour ago from the FT, the Financial Times. And it's from El-Arian. And do your research on who he is. He's a heavyweight in the financial world, bonds, finances. I think that you'll recognize his name. And so this is a very interesting bit that he published. And it says something strange. And the article is entitled, Why the West Should Be Paying More Attention to the Gold Price. Again, I'm going to go a little long here today. Let me cover this article, okay? Something strange, bear with me, stick with the video. Something strange has happened to the price of gold over the past year. In setting one record level after another, he says, it seems to have decoupled from its traditional historical influencers such as interest rates, inflation, and the dollar. He says gold's all-weather characteristic signals something that goes beyond economics, politics, and higher frequency geopolitical developments. It captures an increasingly persistent behavioral trend among China and middle power countries, as well as others. And it's a trend that the West should be paying greater attention to. And we know that the gold for years has been going from west to east, right? I'm not going to even comment on whether we have the ounces supposedly advertised in Fort Knox. Leave your comments below. Over the past 12 months, the price of an ounce of gold, he says, on international markets has increased from $1,947 per ounce to $2,715 per ounce, a gain of almost 40%. Interestingly, he says this march up in price has been relatively linear, with any pullback attracting more buyers. It has occurred despite some wild swings in expected policy rates, a wide fluctuation band for benchmark U.S. yields, falling inflation, and current volatility. Some may be tempted to dismiss gold's performance as part of a more general increase in asset prices, he says. For example, has been seen the U.S. and S&P index, the U.S. S&P index gained 35% in the past 12 months. He says, yet that correlation itself is unusual. Others will attribute it to the risk of military conflicts that have seen so many innocent civilians lose lives, together with massive destruction of infrastructure. Yet the price journey suggests that there may well still be more. There may well be a lot more going on. Consistent foreign central bank purchases have been an important driver of the gold's strength, and he says such buying seems not just related to the desire of many to gradually diversify their reserve holdings away from dollar denominants, all right? They're also interested in exploring possible alternatives to the dollar-based payment system, right? Here we go. That's been at the core of the international architecture for some 80 years. Ask why this is happening, and you'll normally get an answer that mentions a general loss of confidence in America's management of the global order and two specific developments. You'll hear about America's weaponization of trade tariffs and investment sanctions, together with its reduced interest in the rule-based cooperative multilateral system that played a pivotal role in designating it 80 years ago. It says you'll also hear about Russia's ability to continue to trade and grow its economy despite some of the country's banks being ejected in 2022 from SWIFT. It says SWIFT now has created it's not SWIFT, but he says SWIFT, the international system that governs the vast majority of cross-border payments. But now Russia's and through BRICS, has come up with a clunky trade and payments alternative that involves a handful of other countries. While inefficient and costly, it says it allows Russia to bypass the dollar and maintain a core set of international economic and financial relations, okay? And let me explain this last section, and I'll be done for today. Very important to kind of bring it all together. It says, what is at stake here is not just the erosion of the dollar's dominant role, but also a gradual change in the operation of the global system. No other currency or payment system is able and willing to displace the dollar at the core of the system. And there's a practical limit to reserve diversification, but an increasing number of little pipes are being built to go around this core, he says. And growing number of countries are interested in increasingly involved. What's been happening to the gold price is not just unusual in terms of traditional economic and financial influences. It also goes beyond strict geopolitical influences to capture a broader phenomenon, which is building secular momentum. And as it develops deeper roots, right, these little pipes he's talking about, the risks materially fragmenting the global system and eroding the international influence of the dollar and the U.S. financial system. That would have an impact on the United States' ability to inform and influence outcomes, and it would undermine its national security. It's a phenomenon that Western governments should pay more attention to, and it's one where there is still time to course correct, he says, not as much, though, as some would hope. So I hope you guys got something from that. it's just something that we all need to be paying attention to. And there is a shift underway. You're hearing it all the time. And look at this is playing out right now in a massive spike in the gold price. So again, appreciate you guys watching today and sharing, liking, and subscribing. I will talk to all of you soon. Bye.